So the 2-year Treasury yield versus the 3-month Treasury yield. The longer term yield is below the shorter term, which is not normal. And you can see how abnormal it has been. We've had that inversion in place pretty much since the Fed started jacking interest rates up dramatically, the most dramatic move ever in percentage terms, in percentage change terms. And it's been inverted ever since then. And this is one reason we believe we've been in a rolling recession. And the headline numbers obfuscate this rolling recession. But if you go sector by sector, manufacturing down and out, housing down and out, small businesses constrained by all kinds of metrics, monetary policy is too tight.
Cathie Wood begins her analysis with the latest employment report, a key barometer of economic health. While headline job numbers often grab attention, Wood zeroes in on a subtler but critical metric, the average work week. She points out that this indicator has declined, a signal that may carry more weight than overall job growth when assessing real economic strength. At the same time, the household survey, often seen as a more nuanced employment measure, came in under 100,000, closer to the 90,000 mark. Together, these signs suggest the labor market may be weakening beneath the surface, even as it appears stable on the surface. By the way, if you're enjoying this breakdown, make sure to like the video, subscribe, and drop a comment below. It not only helps the channel grow, but also signals to the algorithm to share this content with more people like you. Let's continue. What makes this particularly important is that bond yields have remained unexpectedly calm, despite forecasts for a much weaker employment report. According to Wood, this calm signals growing market conviction that the economy is cooling, perhaps more than the Fed or policymakers currently realize. Let's go back to the video.
One other source of weakness in the report was the average work week. It was down. And many people don't pay much attention to that, but that can have more of an impact than the change in employment itself. So another sign of weakness. And if you look at the household survey was in the 90,000 range. So again, sub 100,000. So on balance, I would say a weak report. The bond market may have anticipated a much weaker report because of how ADP set us up earlier in the week. So it's down a bit, but bond yields have been very well behaved in the last month, especially with all of the drama around the deficit. So with that, let's launch into these charts. So the first chart here is the budget deficit. Now, it's very hard to see on a month-to-month basis, but actually in the last few months, the budget deficit has come down slightly as a percent of GDP already. You can see here the green line and X depicts where Treasuries Secretary Bessent aims to take the deficit over the next 3.5 years. If our outlook for growth driven by productivity is right, we think he will be successful. So we think that the tide is turning here, and we think the surprises could be on the low side of expectations, meaning the deficit shrinking as a percent of GDP more than people expect. And on the next chart, you can see we featured this last month. The reason we're featuring it again, the corporate tax rate, is it does look that in both the House and the Senate versions of the bill, that full expensing of capital equipment and some structures has made it into the bill, which would take our effective corporate tax rate down into the 14 to 15% range, which will be one of the lowest in the world, certainly in the developed world. And one reason we do believe foreign direct investment will increase in this country. On the next chart, here you can see what I mentioned about M2. M2 is closing in on 5% growth. That's depicted in the purple line here. But if you take a look over history at this chart, you'll see that even that rate is at the lower end of what we've experienced over the years. Now, what's also interesting on this chart is in the 60s and 70s, you'll see M2 growth on a year-over-year basis was outpacing inflation. It was accommodating all kinds of government spending. And you can see that this is pushed ahead by 18 months, that if we're right, the inflation rate is going to come down. And the controversy out there, and I think what Treasury Secretary Besant has been trying to guard against, is that we don't end up in another 70s accommodation period, which led to terrible inflation, double-digit inflation. If we're right, this environment is going to look much more like the 90s, where money growth is above the inflation rate, and actually inflation tends towards a decline. And what that will mean is that the velocity of money is slowing down. Now, the velocity of money, I know I've featured it in charts in the past, but it's been in a secular downtrend since a secular decline. The growth rate had been slowing quite a bit, but the actual decline started in the late 90s. With the occasional cyclical bump. Well, we've just been through the cyclical bump and velocity is starting to turn down again. So that trend is important. If it's still in place, then money growth at this level is not at all a problem in terms of feeding inflation. The velocity is the rate at which money turns over. And why would it decline? Well, if we're right and inflation is much lower than expected and interest rates will follow, including mortgage rates, then the attitude is, well, I don't have to rush now to buy anything because inflation and interest rates are coming down. That's how you get that psychology. And we think that will be at work during the next few months, if not years. On the next chart, here you can see what I mentioned a little earlier, which is the inverted yield curve at the front end of the curve, the short end of the curve, so the 2-year Treasury yield versus the 3-month Treasury yield. The longer term yield is below the shorter term, which is not normal. And you can see how abnormal it has been. We've had that inversion in place pretty much since the Fed started jacking interest rates up dramatically, the most dramatic move ever in percentage terms, in percentage change terms. And it's been inverted ever since then. And this is one reason we believe we've been in a rolling recession. And the headline numbers obfuscate this rolling recession. But if you go sector by sector, manufacturing down and out, housing down and out, small businesses constrained by all kinds of metrics, monetary policy is too tight.
Cathie Wood highlights the inverted yield curve, particularly the spread between the 2-year and 3-month Treasury yields, as a major red flag. This inversion, she explains, has persisted since the Fed's aggressive rate hikes began and suggests that the economy is in a rolling recession. What does a rolling recession mean, according to Wood? It's a situation where different sectors of the economy experience contractions at different times, obscuring the broader downturn in aggregated GDP data. Sectors like manufacturing, housing, and small business have already suffered significantly, Even if headline growth appears resilient, the Fed's tight monetary policy, in her view, is continuing to bite and may already be too restrictive given the economic damage being inflicted.
And it's getting tighter in recent months, as you can see here. This may be what Chairman Powell was reflecting on when he said, maybe without tariffs we'd be easing. On this next chart, here we're going into some of the economic indicators. So this is a chart from RenMac, a service that we use. It's a very good service. And what you see here is the unemployment rate in the dark brown. And in the gray, you can see the labor differential. So labor differential is based on a Conference Board metric, jobs easy to get minus jobs hard to get, or maybe it's the other way around, jobs hard to get minus jobs easy to get. And based on that metric, the unemployment rate is probably going to continue moving up. Now, what happened in this report, it actually ticked down a bit in today's report from 4.2 to 4.1%. One of the reasons is the labor force is shrinking, and probably what's behind that is immigration, the crackdown on illegal immigration and the deportation of some people. So that could be holding the unemployment rate down. This metric, the labor differential, says it's getting harder to find a job. The other metric that suggests that is continuing unemployment claims. They have been rising even while initial claims have been pretty stable. And what that suggests is people who have been out of work are finding it difficult to get a job. And we do know that AI is certainly hurting entry-level jobs. I may have mentioned this the last time. We did our own hackathon at ARC during our offsite, and we now have 13 projects that we internally started coding ourselves. I did a little bit, although I have to give credit to Dan White more for our team getting a project going. Dan White is our associate portfolio manager. And yet 13 pain points within the organization we started addressing ourselves. So this idea of natural language, not processing, but programming. We all speak a natural language. Generative AI is all about natural language programming. And so it is one reason we think software as a service is going to run into a little bit of trouble here now that we can do a lot ourselves and customize to our own organization's needs. The other thing I'll note about this employment indicator is the Wall Street Journal published an article about college graduates having a difficult time getting jobs. And that's what I mean by entry level. If you look at the statistics, what you'll find is the unemployment rate is up. I think the recent low in that metric was 4%, and we're up above 6%, 6.3 or 6.4%, I think. So it is true that college graduates are finding it difficult to get a job, and AI is probably the reason. So the lesson here, anyone who is thinking about changing a job or looking for a job is start focusing on AI. There's a lot you can do yourselves, and follow Frank Downing, who's our director of research on the next generation internet broadly, but on AI specifically, and Joseph Soya, who is a research analyst. Follow them on X. Follow people they follow who are really transforming the world with AI, and learn a lot about it. There's a lot you can do to up your game in that particular realm. On the next page, another indicator that that there is some stress out there when it comes to employment. You can see these are Google searches on how to file for initial claims, initial unemployment insurance claims. You can see it shot up right after the election, because I think a lot of people thought that, oh no, this is going to be a very terrible environment, and we better figure out, if we're going to lose our jobs, what to do next. That kind of settled down. The tariffs have probably set it off again, as well as this notion that AI is starting to displace some jobs, or maybe remove jobs entirely, so they're no longer there for the entry level. So here is real GDP versus productivity. Real GDP is in the purple, and you can see how this rolling recession has been obfuscated, I think, holding real GDP growth up over the last few years as housing has crashed and manufacturing has really been under a lot of stress.
Cathie Wood's analysis offers a refreshing blend of realism and optimism. Yes, the labor market is showing cracks. Yes, inflation and interest rate risks persist. And yes, AI is disrupting traditional job costs. But beneath those challenges lies a transformative opportunity. Productivity is rising. Corporate tax policy is becoming more favorable. AI is not just a threat, it's a powerful tool that anyone can leverage to become more competitive. ARK's core belief remains intact: innovation is deflationary, and that's good news. The coming years may not resemble the roaring post-pandemic rally of 2020 to 2021, but they also won't echo the crisis-laden 1970s. If anything, we may be on the cusp of a new era, one where technology drives both economic expansion and wealth creation in unprecedented ways. So whether you're an investor, entrepreneur, or simply a curious observer of macro trends, Cathie Wood's message is clear. Don't be misled by surface-level headlines. Understand the deeper currents. Be informed, and most importantly, prepare for the future, because it's arriving faster than you think. Thanks for watching. See you on next one.